Good morning, everyone. This is Daily Trading Analysis with a weekly recap, weekend video. We are going to start with the fundamentals for the week, going through the FOMC minutes, and also what to expect from some of the Fed statements. Fed Goldsby on Friday afternoon provides some sentences, some information that tanked the market during the afternoon, and people is asking why. So we are going to review also those, but let's start with the FOMC minutes highlights. Most Federal Reserve policymakers decided to maintain the interest rate unchanged in order to assess the impact of previous tightening measures. Remember that the hiking interest rates that aggressively as they are doing, it has a lag impact. So we are going sometimes to wait and see. We need to wait and see the impact on the economy in all the sectors. But look at this. The latest projections indicate that FOMC members expect interest rates to reach 5.6 by year end. And this is key to understand because markets were not buying these in their predictions and in their price action, suggesting the possibility of two more quarter 25 basis points hikes this year. Markets are only pricing in one interest rate hike this year, still going against the Fed. The minutes highlighted the uncertainty around the economy outlook and the potential for a mild and short recession. This scared the heck out of a lot of traders and investors. Concerns exist regarding the banking sector and more specifically the credit tightening due to weakness in this area. Fed are not willing to increase and they are willing to wait because increasing rate hikes at the same time banking sector is doing a credit tightening, not providing some lends and not being so easy to gather credits from the citizens. They are better waiting because this credit tightening has the same effect in the economy as to raising interest rates. So they are waiting to see if the banking sector aggressively applies this credit tightening in the future. And future policy decisions will be made based on available information. They are data driven as always. They've said that every time. And the possibility of consecutive rate increases, plural, increases. So they are going for two, basically. They are very clear, but markets are not buying that. Let's now review about Fed Goldsby. Goldsby provided these sentences, these statements in the afternoon of Fridays. And as you can see, we are going to review the price action during that afternoon. That was a bloodbath. That was a complete reversal of the highs after breaking out. And let's see what Goldsby said. Getting to a more sustainable pace of job gains. So after the data, they see a sustainable pace of job gains, but it is clear that job market is still very strong, but cooling. This is good news. We can get the unemployment rate not to a recession level and still get prices down. So unemployment rate can go up, but we should not enter into recession. Some analysts and some media are saying that if unemployment rate goes up, we are going to enter a recession. And that's not true. We are at almost all-time lows in unemployment rate. 3.6% is extremely low. And there's for sure potential to increase this unemployment rate to really lower the pressure of wages, lower the pressure of consumers, and still not enter into recession. Inflation is down somewhat, but needs to come down more. Obviously, we are super high. And be careful with this one. I haven't seen anything that says one or two more rate hikes this year are wrong. We can have one or more rate hikes this year. They are still saying two more rate hikes. One for sure, two more rate hikes. They don't see progress. They see strength in the economy and wages are going up, jobs are going up. So it's quite clear their message. There are modest increases in rate come. Timing is a question. The question is when to do it, not if they will do it. But markets, as always, are ahead of themselves and they are still trying to predict, trying to price in that they are not going to do that. Let's do a quick recap of the economic data really quick. On Monday, we got manufacturing PMI showing lower expectations. So manufacturing going lower is good news. The next one on Wednesday were the FOMC minutes that we reviewed. Thursday, we got services, all about services. Remember that services has the most peak inflation of all sectors, and services PMI came super high. We were expecting 51, we got almost 54. Job openings came lower, but still services employment higher, services prices higher, new orders higher, a lot of pressure on these services. And on Friday, we got the tick lower on unemployment, 3.7 to 3.6 as expected, non-farm payrolls lower, but average hourly earnings month over month came higher than expected, the same as the previous one, and earnings year over year continuing higher. We were expecting lower, so wage pressure still there. Wage pressure is still there. So we are going to review now the markets because they started thinking that perhaps we can get rid of this second rate hike because it's all about 1 versus 2 more rate hikes. And basically, let me share the screen. Basically, they are all thinking about 1 versus 2. And depending on if the data supports that, the markets continues higher or really sells off. This is the NQ continuous chart, futures. As you can see, we are still at that level of resistance. We try to go higher, but we basically, this is the daily chart. If we turn to the weekly to really see some perspective, look at this. We were closing right there 2 weeks ago, and now we are trying to close higher, but there's no clear close higher. There's no big break, like for example, this week on this pivot. So we are still feeling the pressure up here. And this is a quite high level of resistance. Look at this. 1 year ago, on January, we got these tails. And on the daily, we can clearly see there was a lot of uncertainty up here. This doji, all this break and down, breaking this low, this was extremely nasty. And we for sure can offer a pullback up here. We have some levels, these 2 weeks on the weekly, and then we have this consolidation that provided this huge breakout. And on the daily, if we go to this contract on September, you can see that we did this higher low, but we remain in range of the weekly. This blue dot line was last week high, last week low, and after this second breakout, we are trying to break. Is this a double top? It might be. But we have to focus on this pivot down here that provided the higher low, and then last week low that will remain, it will be changed basically to up here. So we are going to be in this narrow range next week. The weekly chart, we go to the daily. We need to see if we see this kind of move lower, we have to pay attention to this pivot. And then if we have this pivot, then it's a lower. It's an indication of maybe it's a change of trend. A lower intermediate low, it's kind of an indicator, a sign that maybe the trend is changing, and this might be a double top. So this is the setup for the upcoming weeks and upcoming dates. We are still in range, but this topping tail on the daily, if we go to the 1 minute chart, we can see the nasty price action on Fridays. This was the unemployment rate and all the news that came. We started trying to go higher. We were chopping around there. This was a clear level, this structure up here that provided the initial sell-off, consolidation, and the second sell-off, and 100% retracement of the news. So this was clearly a level to watch on the Nasdaq. And we basically broke it. We swiped the lows and we started grinding higher. Look at these tails. There was a lot of pressure. So there was no clean price action, bullish price action. It was a really battle. And once we broke out, I have an alert here, and I was watching price action up here into this, the big retracement on the news. We consolidating and we push higher. This was quite bullish. We are starting going up, but then Goldsby reminded everyone that the most probable outcome is 2 more rate hikes, and we have still a lot of progress to do, and data is not progressing as expected. So markets really didn't like that and finished the week on the red. Not super in the red because this is basically an inside candle on the weekly, but I think this move got a lot of traders unexpected. So be really careful with that. Let's review the dollar because dollar did something interesting also. Look at this red candle. Dollar finished the day minus 0.82%. And on the weekly, we have this rejection. So basically we try to pull after the higher low, a higher high, and we got rejected. And this is a brutal candle, closing at the lows. We are still at this level of lower highs, higher lows, sorry. But I mean, after this candle, I might expect dollar to continue weakening. And usually when dollar goes down, stock market goes up. But I don't think dollar going down, it's 100% sure that stocks are going up, because dollar is basically a refuge for a lot of traders. And I think we might see a reversal down here, still watching for 100 parity, but 102 may provide again some level of support, building some structure, and then building higher. But this is a possibility. So watch the dollar because it's super interesting, the same as yields. We are talking about interest rates, we are talking about the economy. We have to watch dollar and yields. It's key markets that you need to see in order to gather the overall sentiment and convergences and some confluences in other markets. The 2-year yield pushed June 2007 level of 5.1%, but it retraced. Then it went lower and it came back up. So look at this price action. This was basically confusion from everyone if we are going to continue higher, if we are cutting rates, but not. This is super important, but still, look at this volatility. Markets don't like volatility in the 2-year yield. And if we swipe the highs and we kept lower, if we swipe the lows and we came back up, watch the 2-year yield because it's super important. And the most important yield of all is the 10-year. We are approaching this pivot at 4.1%. That's unbelievable. And look at this strength. The 10-year is threatening because we are avoiding recession. But the 2-year yield that is controlled by the Fed and the rates, it's super choppy. That's why if we check the inverted yield curve, we can see this swipe of the lows. We inverted way more till minus 1%, and then we push higher. This is caused by the 10-year yield pushing higher strong because we are basically in a scenario in which we avoid recession and beat inflation. But the real deal is up here. This is the real deal. We still have to revert the inversion. And we have ways to go. Basically, we are at minus 0.75%, 75 basis points still to be reverted. And look at this consolidation, and we went lower. Still a lot of progress to be done, to be made, but the target, the goal is to be up here in the zero line. That way, the 2-year and the 10-year will revert the inversion, will stop being inverted, and most probably we will enter a recession. that recession will be called out, either mild, short, or whatever, but this inversion will cause markets to really react. Watch that. Remember dollar, yields, strength, and this is all about interest rates. If we check December interest rates, futures, look at this. 5.6 before SVB disaster, and then going up again. 5.4, and as Goldsby was saying, 5.6. Look at this, 5.6 is the target. So watching these interest rate futures to really gather the sentiment about future rate hikes, it's quite important. And the same goes to the probabilities. The probabilities didn't change much on this scenario, but 1, 2, 3, 4, 5, 6 meetings flat. This is what analysts are expecting. 6 months being at 525, 550. Remember that right now we are at 525. So with 93% of probability, we are expecting at 25 basis points a net meeting, and this 70% is quite interesting in September because it goes 70% and then 34 for another 25 basis points in November. This November is quite volatile. And this is the point in which I think if Fed is going to really raise rates again and caught the market unexpected, this is going to be the month, November. But then we enter 2024, and neither January, neither March, we are expecting cuts. Analysts are expecting cuts in May. So we are going to be a lot of months at these high levels of interest rates. And it's going to cause a lot of damage to the economy. And this is why you have to really think about all these in conjunction, really build with all the pieces the complete picture and really analyze if is tech stocks, is the market overextended with the outlook on this economy and the possibility of further rate hikes. For sure, I think some stocks, we are going to review now all the big tech stocks and see how they look like, because you will really understand why some of the tech stocks need a pullback. And I don't expect the Nasdaq to continue much higher with all the pressure that is building up and with all the price action that we are seeing in smaller time frames. We are seeing these kind of things. If we check the 30-minute chart, look at this. This was a huge push up, rejection, and then a harder rejection. This is a lower low on the 30-minute chart. We are going to see 15,100 more or less, and last week low to see continuation, because if we see continuation, we can start, we have to start thinking about a change in trend and watching this 14,800 below 15,000 psychological level, starting to see this trend change to the downside. So let's go and review all the stocks. First, Apple, all-time highs 194. This was a previous gap that got filled, so we can get rid of that. And I would like to track this level, 189.59, because I think this price action doesn't provide any big pivot unless we basically start pulling towards these two levels, the previous close, and then this support. That's a really big move for Apple. If Apple starts going this way and doesn't find support on the 20 moving average on the daily, I mean, look at these gaps behind. There are 3 gaps that are way lower, and it may be filled. With time, they should be filled. But there's a potential to the downside now that with this price action right below all-time highs, Apple might see some further weakness. Microsoft finished the day on Friday minus 1.20. This blue-orange dot line was the previous all-time highs. We broke that and we got instantly rejected. This is the first sign of weakness of Microsoft not being able to push harder. We are now hugging the 20 on the daily, but look at this level at 342. I still think this range is important. But look at these gaps below. This one that might provide some support, and also this level we might feel and reject. But look at the range on Microsoft because it's quite important. You are going to see on all these stocks that all big tech stocks are leaving behind huge gaps. Tesla, look at the number of gaps that is leaving behind. And also, I highlighted this because this is a possibility of an island reversal. Tesla finished the Friday 0.76 in the red. If we gap down, we fill this gap and we start going lower. This would be 4-day island reversal, gap up, consolidation, and gap down. This is a strong bearish signal. And we might focus on gathering this gap and then the small ones over time. But this will be huge for Tesla. Amazon was trying to fill this gap from September last year, but is not able to do that. Look at this. This was the previous gap that got filled on Friday. So we gap down, we filled the gap, and basically we closed with weakness. So again, we are seeing weakness up here, a dulling market. And there are some levels down here. The gap on Amazon is way below. But look at where is the daily, the 20 DMA. It's up here, and we might see this kind of move or even this for a nice change in trend. These levels supports a lot of structure. So basically, we might see something like this, start stepping down and changing the trend. On the daily, the same for Google. Google rejected this level on 186. We didn't close up here, and we started, look at this change in trend. We changed the trend already with lower lows, lower highs, and we are going towards this gap. So this gap 115, and then we have the structure before the big push on Google. So watch this gap and watch this level of structure around 110, 109, 110, 109. And as you can see, every stock is feeling the pressure. Nvidia, new all-time highs after this pivot, but look at these two candles. Even though they are green, they are not providing confidence about further moves higher. Sure, some of you might think that we might push and squeeze higher, but Nvidia is at all-time highs and 439 with an unbelievable move on AI hype. So what is the possibility of continuing higher? It might, but we need to think about a fib retracement that aligns with this small gap down here that didn't get filled, and we might fill this one, and basically a move like this will provide a lot of people with issues with the positions if you don't see really the sentiment on Nvidia. I would like to see stronger green candles below all-time highs in order for me to be confident about a breakout to the upside. But these two candles are concerning, and I would expect some kind of move like this to fill the gaps that are leaving behind. I think Nvidia will be able to hold this huge gap, and we have usually 50% retracement or higher on the gap is bullish. So if we do things like this, we have to really see if the lower high targets the gap entry and rejects, continue lower, or if we see the partial gap fill and then reclaim of the previous trend. So a lot of possibilities on Nvidia. It's the only one that it's looking viable to really hold on the long term. Meta, the last one that I would like to highlight, look at this huge gap that was from this level. We already retraced this I think a lot of meta participants are looking forward 300. We tapped 298. The gap fill complete is 323. I don't know if that's going to happen, but look at this grinding price action. I mean, anything can happen. We have to really see the candles, and this candle is not good. Gap below, there's a lot of gaps below, the same as above. So Meta with these threads app that is facing against Twitter. I don't know the future, but we have to really see the daily movement. But Tesla is concerning with this possible island reversal. Apple and Microsoft are quite weak. And also Google is actively trending down already. So this is my analysis. This is my understanding of the market. Last thing I would like to review, as always, I would like to check the performance on the sector funds. And for that purpose, we are going to review the 5-day performance. This is the 5-day performance. Look at this. XLU utilities is the first one. Healthcare is in the other in the other side, the worst performance. And XLP staples is in the negative. This is the 5-day performance. So nothing huge here, nothing pointing towards a rotation to defensives. Let's see the 1 day on Friday. Energy got a huge push, and again, staples, healthcare, and utilities are not higher. So I don't see a rotation to defensives yet. I think we have still to wait for news and for the rest of the economic calendar, and also watch earnings, because next week earnings is going to start in 2 weeks, and that is going to be insane, because all these mega cap tech stocks, if they miss a little bit, or if they start to show some kind of miss on earnings, investors will jump out of the boat and will start the bloodbath. So be really careful, because right now they are really happy because we got a huge move on the tech stock on the Nasdaq, huge percentage. But this might be buy the rumor, sell the news. And if they are starting to see that the expectations for earnings is not good, we might start seeing some more selling pressure. Regarding next week, a lot of Feds speaking on Monday. So we have to really pay attention to what they say. Tuesday, nothing burger. And on Wednesday, we have the big day, CPI. CPI is going to be a huge data coming up next week. We are expecting month over month to increase, year over year to decrease, because remember that we are getting rid of those last year huge numbers on March, April, May, and June. So year over year, it's going lower, but don't be confused. Don't get tricked here. Month over month is what you really need to watch. And more than that, core inflation month over month needs to really show signs of cooling down. And then on Thursday, we have the PPI as always, but initial jobless claims as all weeks, and on Friday, consumer sentiment. So starting the next week with the Feds and then topping with CPI, PPI, and consumer sentiment is what you need to watch. And also on the back of your mind, remember that we are going to enter earnings in a couple of weeks. We are going to review those earnings in this channel. So if you like what you're seeing, if you like the kind of analysis that I perform, please subscribe to the channel and like the button. And remember that I upload every single day videos for market forecast, market updates, and market recaps. And on the weekends, like this video, I provide some kind of recap of the week in order for you to gather the sentiment, and I like to provide my understanding and my knowledge of the markets, what I saw, what kind of highlights I would like to see, forecasts, and these kind of things. So I hope you found this video useful, and thank you for your support. Have a nice weekend, and remember that the most important things in these markets and for your career as a trader and investor are discipline and risk management. Discipline and risk management. This candle and the weekly in red might be super useful. Manage your expectations and just read the charts, read the price action, watch the dollar and yields, and let's see what happens the next week. Thank you, everyone. Have a nice weekend. Stay safe and see you on Monday.